This is Scott Becker with the Becker Private Equity and Business Podcast. We come to you regularly with short business episodes, concise private equity episodes, interviews with brilliant leaders in the private equity and healthcare and business world, as well as sometimes irreverent episodes that are just based on the stupidity of life and so forth. But today's episodes with a brilliant leader who is at the cross section of private equity and healthcare. We're joined by Amber Walsh, who's also on the executive committee of McGuireWoods. She works with some of the largest funds and companies in the world in the deal environment. And we're going to talk about today, we're seeing deals start to pick up of all sizes. At the same time, deals are still taking a lot longer to finish. People are more cautious about deals. We're seeing blown up deals. Amber, talk to us a little bit about the deal climate and why some deals get closed, some other deals don't get closed. Tell us what you're seeing.
Yeah, absolutely. Thank you, Scott. So the deal climate certainly has picked up in 2024. We're, just crossed the halfway mark of 2024. It has certainly picked up as it started to pick up at the end of 2023 again, after the record-breaking years of 21 and 22. It's starting to pick back up again. But we are seeing an unusually high number of broken deals. And what we mean by broken deals, of course, is a deal that gets to a certain stage between buyers and sellers and other participants, lenders, et cetera, that doesn't ultimately manifest in a closing. In addition to broken deals, we're seeing broken processes. So when a particular platform will go to market, sometimes intentionally testing the waters, knowing that they may not choose to transact if there's not the requisite level of interest that they're looking for. But we're seeing broken processes. And there's a number of reasons that that's happening. But when it does, it has this ripple effect, of course, on all of us who participate in the industry, because it means longer times to return capital to your limited partners who have invested in that platform. It's longer time frames for the lawyers and the bankers to get paid. It's just a little bit longer. And in some ways, it was a good thing to kind of reset to normality after the frenzied pace of 21 and 22. Deals are still getting done. There's just an unusually high number right now where we are seeing break before closing. And it's just something that we're dealing with right now and hope and expect that to smooth out, certainly in the coming months.
And talk about that. You've mentioned so many different pieces of this. When deals are getting broken or processes broken, is it typically a buyer getting cautious? Is it a retrenchment by the buyer that causes a seller to walk away? What are some of the things that are driving sort of broken processes, broken deals?
Yeah, a lot of times there's numerous reasons why it happens. But the key causes, I think, are additional caution by buyers on the regulatory environment. There are deeper dives, a lot more tire kicking, particularly with the high cost of capital, which we still see, despite the fact that we may see lowering interest rates soon, there's still a high cost of capital. So with a tougher regulatory environment, with scrutiny on a lot of different areas of healthcare around the country, the high cost of capital, you see buyers really doing an extreme level of diligence, and not just the equity buyers, but the lenders, the rep and warranty insurance carriers, everyone that has their stake in the deal. And then the sellers, I think many sellers have embraced more modest valuations and go to market with more modest expectations on valuations than they did 18 months ago. But even still, there's always going to be that tension point between how much a seller is going to tolerate a buyer's intensive diligence process and potentially repricing versus the seller's desire to transact. And you see a lot of sellers just making the choice that now is not the right time. So we see a lot of sellers who have just said, look, we tested the waters. We know what's out there right now. We're going to wait a little bit longer. And consequently, we're also at an all-time high for hold periods. So by the end of 2023, so, tracking right at January 1st of 2023, we hit an all-time high for long hold periods for private equity funds and their healthcare investments, just north of 7 years. It had previously been much shorter than that. And that's just one of the effects of this.
When you talk about those longer hold periods, I mean, we're obviously, you and I are both investors in funds. We're obviously investors on a very small scale compared to the big institutional investors, the big pension fund investors, and so forth. But it's almost like for anybody that is an investor in funds, we all see this slower return of capital, especially as we ante up for the next round of investments. And I guess it's very similar in some ways to in healthcare. Every single one of us is a consumer, so some of us might have more privilege or access than others. But at the end of the day, all of us are consumers, and we all see the shortages, the sort of long waits at ERs and so forth. What is the sense of the longer hold times for funds vintage 2018, 19, 20 that we're still sitting on? What is the expectation on that? You would have thought with the stock market exploding, there would have been more transactions, but private equity buyers are in a different game because, meaning exploding upward, surging upward, you would have thought there'd been some more access and exits. But private equity buyers are a little bit different game because they're still doing deals with leverage, and leverage is still expensive. Is there, hope for those funds that we all invested in 2018 to 21 that at some point we'll see returns?
I think there certainly is. There are many reasons to be optimistic. And Scott, that I generally view the world through an optimistic lens, but there are a lot of reasons to be optimistic for that. So the first, of course, as I mentioned earlier, the possibility of cheaper capital with a reduction in interest rates. You also have an all-time high for dry powder, where I think there's $1 trillion in dry capital in private equity, where you've got committed capital that needs to be spent. So that's where you bring in the you and me and the much larger investors who are sitting there with capital commitments and want this to be spent. There's a lot of pressure from investors to transact. So I think, that pressure is creating some push. You also are seeing some funds who are looking to do alternative ways to return capital to investors. So the proliferation of continuation vehicles, that concept where you've got a private equity backed platform, and instead of selling to another platform, bringing in a third party investor, going public, et cetera, you're taking that asset and rolling it out of your existing fund into a different investment vehicle that's led by the same general partner, so that you can return capital to the investors in the old fund and have kind of a capital restart with the next fund or alternative investment vehicle. So you see general partners that lead these funds really listening to their investors, starting to move, starting to be a little bit more aggressive, but then also look at these alternative options like the continuation vehicle. So I think there's lots of room for optimism here. And we see this anecdotally. We also see this reported out by GPs in their activity levels and the pressure that they are feeling from their LPs. So that is a very long way of saying, yeah, I think there's reason for optimism.
No, that's fantastic. We've seen a continuation fund in different ways of trying to refinance deals, take some capital out. Some investors invest forward, some don't. Fascinating to watch different ways. I mean, there was a discussion by one of the Bain principals or somebody about different methods, payments in kind, other kinds of things, which aren't really like taking capital out exactly. But no, it's a fascinating perspective. And I take it this is probably often the case until the interest rate climate gets better and better, when leverage is a little cheaper, that you're going to see broken deals because people are going to be quite careful about what they price at because there's just been so many challenges with higher leverage and bolt-ons and so forth. What a fascinating environment, for someone like myself who finally got into the game of being a true private equity venture capital investor 5 to 8 years ago. I was like, oh my goodness, I was so excited about the returns that all my colleagues had all these years. And it's a little bit more complicated than I'd expected or hoped. Fascinating. Amber, I want to thank you for joining us today on the Becker Private Equity Business Podcast. I always learn something. You've just got your eye to what is going on like almost nobody else in the country. Thank you for joining us today on the Becker Private Equity Business Podcast.
Thank you, Scott.